This is a BC Eagle Finance video, Brigham and Houston Chapter 4, feedback on AST multiple choice questions. The first question that we can take a look at is item number 4, and this deals with the different forms of efficiency in the economy. So if two firms have identical assets but they have different financing policies, firm L has decided to use a lot of debt, which will throw off some interest costs, while firm U chooses only to use common equity, which would pay dividends. Remember that dividends are not expenses on the income statement but represent distributions of income after the income is determined. Dividends are not part of the income statement. The future state of the economy could either be strong or weak. Firm L, that used a lot of debt, would probably be the better one if the economy turns out to be, okay, if a company has debt, it will also have more interest costs. And to cover the interest costs, the business needs more sales. So, to get more sales, the economy must be very strong. Let's take a look at item number 8. Item number 8 says the ratios for a well-established, relatively stable company whose results are quite predictable would be relatively constant at each point in time, such as the end of each month during the year. Okay, now you have to have a little familiarity with financial statements to really respond to this one. So let's take a look at a company that you've all bought product from, and that would be Mattel. And so this piece of information here comes from Bridgewater College's Mergent Online financial ratio database that you can get through Mac Library. So here you see quarterly information for Mattel. And as you can see, if we take each ratio at the end of each quarter, that's at the end of every 3 months, you can see that they are very diverse. And even if we compare the March 2018 values to the March 2017 values, these ratios each show a wide discrepancy. So, if you have a well-established, stable company, are the ratios going to be the same at the end of every period, whether it's a month, a quarter, or a year? Not really. Let's take a look at item number 16. If operating conditions held constant, Key's return on assets, which would be net income divided by assets, would decrease if it used more financial leverage, which means it took on more debt, or its amount of debt to the amount of capital percent would increase. Capital is the amount of total financing that's comprised of both debt and equity. Again, let's take a look at the formula for return on assets. The return on assets is the net income divided by total assets. So if a company used more financial leverage, that means it would have more interest expense. More interest expense means less net income. So the numerator would go down. If the numerator of a fraction goes down, that means its result would go down. So if Key's increased its financial leverage, its return on assets would decrease. Item 21. The DuPont equation shows that a firm's return on equity, ROE, is equal to its profit margin, net income divided by sales, times its total asset turnover, sales divided by total assets, minus the equity multiplier, which would be total assets over the common equity. Well, let's examine this. Each of these ratios look okay, but let's put the entire return on equity DuPont formula together. The profit margin is net income to sales, so that's correct, times the total asset turnover, which is sales to assets. That one is good, but we are multiplying by the equity multiplier, also known as financial leverage, which is total assets to total common equity. Okay, so this problem would be false. Let's look a little bit closer, though, at the DuPont formula. The DuPont formula itself was started 120 years ago by the DuPont de Nemours Corporation, which makes chemicals and dynamite in Delaware. And they were expanding very rapidly and wanted to discover what really drove profitability. And they broke the profitability into three basic areas. Profit margin, which is the ability of sales to generate net income. Next would be the productivity of the assets, the ability of each dollar of assets to generate sales. And third, the use of financial leverage. In other words, how many dollars of assets could each dollar that the owners put up support? So the return on equity is based on the cents in income that each $1 of sales generates. And to generate income, you have to have higher sales, which come about because you have a brand image that is strong. For example, Nike's brand image for shoes is stronger than Skechers. And secondly, the business would have to control costs, less expenses. So higher sales, less smaller expenses would give higher net income and thereby increase the profit margin. For the assets, how many dollars of sales each dollar invested in assets generates. So the more dollars in sales each dollar of assets generates, the higher the productivity of the assets. And finally, for the equity multiplier, how many dollars of assets does each $1 of owner's equity support or buy? Debt can be the friend if the company has a lot of sales. Debt can be the enemy if sales don't come through. So leverage is one of those tools that businesses use when they forecast higher economic conditions in the future. Item 24. This is a tougher one, so let's just take a look at it. Etzkorn Corporation's year-end assets were $1,650. Its sales for the year were $2,730. Its operating costs were $2,438. Its interest charges were $52, and its tax rate was 40%. It had total liabilities of $300, consisting of $225 of accruals and $75 of notes payable. Its long-term debt is $450. Etzkorn uses only debt and common equity in its capital structure. And using the DuPont equation, what is Etzkorn's return on equity rounded to the nearest percentage? Well, okay, we know that the DuPont formula uses net income, total assets, and total common equity. So first, we need to calculate the total income. So here you have it. Sales less the operating costs gives you operating income, or EBIT, less the interest gives you income before taxes. 40% of the income before tax gives the tax of 83, and taxes from the pre-tax income gives net income of $124. Next, we will need to calculate the shareholders' equity. We know that the balance sheet balances assets equal liabilities plus owner's equity, so assets less liabilities would give us the owner's equity. So 1650 of assets less current liabilities of 300 and long-term debt of 450 produces shareholders' equity of $900. And finally, putting things all together, we could calculate the three individual ratios that comprise return on equity. First is the assets turnover. Sales divided by the assets gives the asset turnover, meaning that each $1 of assets generates $1.65 in sales. Second, the profitability of the sales. Take net income and divide by sales. That produces a nickel of profit for each dollar of sales. And finally, there will be the financial leverage or equity multiplier. Assets divided by the common equity will give financial leverage. Putting all three of these together, we would take the asset turnover times the net profit margin times financial leverage. We would get return on equity. So the return on equity says for each dollar of owner's equity, the owners should expect 14 cents in net income. Item 26. All of the asset turnover ratios are formed by dividing a balance sheet asset by annual sales. This tells us how frequently the assets are used up and replaced during the year. Okay, so let's take a look at what the asset turnover ratios are. We have two of them in this chapter, total asset turnover and fixed asset turnover. Both of them start with sales and divide by some level of assets. The total asset turnover ratio uses total assets, and the fixed asset ratio uses just the net fixed assets, plant, property, and equipment, less accumulated depreciation. All right, so what you're trying to find is how many dollars of sales each dollar of investment in these asset bases generates. And so in this case, we are dividing an income statement item divided by a balance sheet item, the reverse of what's reported in the first sentence. The second sentence tells us how frequently assets are used up. Not really. It says how many dollars of sales each dollar invested in assets generates. Turnover ratios show the productivity of the assets. Item 30. This is Etzkorn again, and Etzkorn Corporation's year-end assets are $1,650, its sales are $2,730, its operating costs are $2,438, its interest charges are $52, and it has a tax rate of 40%. Total current liabilities are $300, and they consist of $225 of accruals and $75 of notes payable. Long-term debt is $450. Etzkorn uses only debt and equity in its capital structure. And what is the equity multiplier? The equity multiplier would be total assets divided by the shareholders' equity. So let's see if we can figure what those two would be. First, let's calculate the shareholders' equity. Since the balance sheet balances assets less equals liabilities plus owner's equity, assets less liabilities should give the owner's equity. So assets of $1,650 less current liabilities of $300 less long-term debt of $450 gives shareholders' equity of $900. Now let's compare that to the financial leverage ratio. We're given that the assets are $1,650, divide that by the common equity, and we have financial leverage of $1.83. To interpret this ratio, we would say that each $1 invested by shareholders can support $1.83 in assets. So the owners can control $1.83 in assets by only investing $1 of their own money. Let's take a look at 34. Firm X has $500 of assets, $1,000 of sales. It has operating costs of $700, including $10 for lease payments and operating cost, and $100 of depreciation, also an operating cost. The company has no amortization charges, and its total liabilities are $100, consisting of $75 of accruals and $25 of notes payable. Its long-term debt is $250 and its interest charges are $35. The firm's debt includes all short-term and long-term interest-bearing debt, but it does not include operating items such as accounts payable and accruals, which is typical. What is the firm's times interest earned ratio? Times interest earned is EBIT, earnings before interest and taxes, divided by interest expense. So here's how it would look on the income statement. Sales of $1,000 less the operating costs of $700 produce EBIT of $300 less the interest expense, and you would have income before taxes of $265. So the times interest earned shows the relationship of interest expense to the EBIT. Bankers want to know that the operating income is high enough to support their interest expense. And bankers at a minimum would like to see a times interest earned of about 6% depending on the industry. Did I say 6%? 6 times depending on the industry, meaning they would like to see $6 of operating income for each $1 of interest. So times interest earned would be the operating income of $300 divided by interest expense of $35 to get times interest earned of $8.57. This says that the company generates $8.50 of EBIT for every $1 of interest expense. That's a pretty good interest coverage rate. And finally, let's take a look at 35. Firm X has $500 of assets, $1,000 of sales, operating costs of $700, including $10 of lease payments and $100 of depreciation. There are no amortization charges. It has total liabilities of $100, consisting of $75 of accruals and $25 of notes payable. It has long-term debt of $250 and interest charges of $35. The firm's debt includes all short-term and long-term interest-bearing debt, but excludes operating items such as accounts payable and accruals. What is the firm's debt to capital ratio? In other words, debt to the total capital, which is debt plus equity. So we want to find out what percent of debt is involved with total financing or total capitalization of this company. So let's put things together. Let's first find the total debt. So total debt would be notes payable plus long-term debt to get total debt of $275. Now let's find the total capitalization or invested capital. We know the balance sheet balances, and so let's take assets less all of the liabilities and long-term debt to get shareholders' equity. This would be the equity capital in the business. Total capitalization would be the sum of debt capital plus equity capital. So $275 of debt capital plus $150 of shareholders' equity produces total capital or total financing of $425. We want to find what percent total debt is of total capitalization. So total debt $275 divided by total capital $425 gives a debt to capitalization ratio of 0.6471. Or to put it another way, there will be 64.7 cents of debt for every $1 financed by the business. That's the end of this review. keep calm, and do well. Thanks for listening.